What if Bitcoin's next all-time high is just weeks away? Despite market turbulence, Bitcoin has quietly gained 29% in the past month, even as traditional markets struggle. While many investors wait for clear signals, smart money is already positioning. In this video, I'm going to show you the real-time indicators and global shifts pointing to an imminent breakout. To understand why Bitcoin is gaining strength so quickly, we need to take a look at what's breaking down across traditional markets. Investor and corporate confidence are eroding faster than the media is willing to admit. Jamie Dimon, CEO of JP Chase, recently said that a recession is now the likely outcome as tariffs and economic uncertainty ripple through the system. American consumers are just as worried. The University of Michigan's latest survey shows that only 12% of Americans expect stocks to rise in the next year. The lowest optimism on record. Unbelievable, right? Foreign investors are already acting. Over the past 2 months, $63 billion has flowed out of US equities. And at the same time, the share of US government debt held by foreign entities has fallen to just 33%, the lowest in 25 years. Ray Dalio recently warned that rising protectionism, growing national debts, and deglobalization are setting the stage for a breakdown of the international money system. When major US holders of US assets begin to exit, it accelerates stress throughout the global financial system. Adding to the pressure, Goldman Sachs now forecasts that the US will post slowest economic growth and the highest inflation rate among developed countries in 2025. Insane stats out there, what people are thinking, guys. And on the surface, it's easy to see why. But as you're about to learn today, all we have to do is dig a little bit to uncover the bullish truth of what's actually happening. So if you're already subscribed to the channel, then you're already way ahead of 8 billion people on the planet when it comes to positioning yourself for a much brighter financial future. And if you're not already subscribed, make sure to hit that subscribe button and turn the bell notifications on and join one of the most educated and prepared audience in the world. And for all of you, if you're excited to find out why most are wrong out there and how by learning this info gives you what you need to be a global macro investor with an edge, then you know what to do, guys. Destroy that like button and let's get into it. So periods of low growth combined with inflation tend to weaken currencies, shrink investment returns, and erode the real value of savings across an economy. There are not disconnected events. There are clear signals that the current systems are becoming less stable by the day. Something serious is brewing beneath the surface of global trade, and it's showing up first in shipping routes. Container ship traffic from China to the US has absolutely plummeted. Over 40% of sailings on major Asia-US routes have been canceled, a rate that typically signals acute disruption. And because ocean freight takes 4 to 6 weeks to reach US ports, we're only now starting to feel the first effects. By May 10th, nearly all inventory arriving on US shores will have been shipped before the latest round of tariffs. After that, restocking slows to a trickle, grinds to nearly a halt. Most Americans won't notice at first until certain products quietly disappear from shelves. Delivery timelines stretch and prices start shift without warning. That's why this moment matters. It isn't just about tariffs. It's about timing of how economic pressure builds. When companies can't replenish supply, they stop hiring. When their margins shrink, they cut spending. It all happens with a delay, and that delay is now running out. At the same time, the US Treasury is borrowing aggressively to cover rising fiscal needs. In just one quarter, its projected borrowing soared by 320%, now reaching $514 billion, right as bond markets are signaling unease. The yield premium on US Treasuries just hit an 11-year high, meaning investors are demanding more compensation to take on government debt. Add in slowing job openings and persistently high inflation, and the signs become hard to ignore. This is going past a normal slowdown. It's a slow motion tightening that will start to move fast once trade effects filter through. While economic stress continues to build from trade disruptions, borrowing spikes, and supply constraints, something very different is happening beneath the surface on global markets. Central banks aren't just watching, they're quietly responding. Around the world, liquidity is starting to really flow again. M2 money supply, which tracks the amount of cash and cash-like assets in circulation, is rising after years of tightening. Historically, Bitcoin has followed these liquidity trends with a delay of 2 to 3 months. That window is now opening, ladies and gentlemen. Michael Howe's liquidity index confirms that global liquidity has reached new all-time highs. Cha-ching! This matters because when liquidity expands, capital rotates into scarce, non-inflationary assets, and Bitcoin is uniquely positioned in that category. We're already seeing this liquidity translate into institutional positioning. Last week, Bitcoin ETFs recorded over $3.4 billion in net inflows, the third largest inflow week on record. That kind of volume is not driven by retail speculation. It's coming from institutional allocators shifting capital into Bitcoin in size, responding to signals, not stories. The surge in institutional inflows isn't just happening in the background. It's part of a larger shift in how Bitcoin is being treated on the world's biggest capital allocators. Following the massive ETF inflows last week, we're now seeing corporations and even governments moving to integrate Bitcoin as a formal part of their financial strategy. This is happening across industries, continents, and asset classes, all pointing to one conclusion. Bitcoin is no longer being treated as a speculative asset. It's being positioned as a reserve. Corporations have now surpassed ETFs as the largest marginal buyers of Bitcoin this year. Let that sink in one more time. Corporations, not just MicroStrategy, but corporations across the board have surpassed ETFs as the largest marginal buyers of Bitcoin this year. That means more Bitcoin is being bought by company treasuries than through institutional investment products, a sign that long-term conviction is driving the cycle. MicroStrategy, formerly Strategy, for example, has nearly completed its $21 billion capital raise just 6 months after it launched it, using the proceeds to buy even more Bitcoin. But it's not just tech companies anymore. A major coal mining firm recently allocated $42 million of its balance sheet into Bitcoin, a surprising move that signals how broad this shift is becoming. Internationally, Brazil's largest bank is backing a new Bitcoin-focused entity with an initial allocation of $210 million. And don't you love this? All of the numbers are in line with Bitcoin. This is just like Bitcoin cultism around the world, the Bitcoin community, the Bitcoin marketing, how it's grown and built in to have network effect. And in the US, Arizona just passed its second Bitcoin reserve bill, a clear signal that state-level support for holding Bitcoin as a treasury asset is gaining massive traction. Even Binance is now advising sovereign wealth funds on how to build national Bitcoin reserves. When institutions begin treating Bitcoin the same way they treat strategic reserves like gold, oil, and others, it tells you that the asset is maturing into something far more permanent. As Bitcoin adoption accelerates at the institutional and sovereign level, another powerful trend is building quietly in parallel, one that's reinforcing crypto's long-term staying power. Over the past week alone, stablecoins added $4.58 billion in market cap, now exceeding $239 billion. Tether continues to lead with over 61% market share, but the growth isn't coming from one token alone. Ripple's RLUSD and Trump's backed USD1 are entering the market with traction, and collectively, these new entrants are helping expand the stablecoin ecosystem beyond its traditional roots. Real-world usage is picking up fast. Chainalysis reports 77% year-over-year increase in stablecoin activity for practical functions like remittances and cross-border payments. These aren't speculative flows. They represent everyday utility, often in places where local currencies fall short. Payment giants are responding. MasterCard has integrated stablecoins into its network by partnering with Circle, Paxos, and Nuvei, allowing merchants to accept payments through stablecoins across a wide range of touchpoints. Stripe is piloting stablecoin payments for businesses outside of the US, giving emerging markets access to instant dollar-based transactions. And guys, I gotta tell you, just from a personal standpoint here, I'm a global citizen, right? I live and travel all over the world. And when I have to make a payment to somebody and they don't accept crypto, you guys can probably relate. How difficult is it to do a bank transfer, a wire transfer, go to Western Union or MoneyGram or whatever? A lot of these things don't work cross-border, like PayPal, for example, and these kind of things. It's just not a globally easy way to send money. So obviously this use case is massive. And for me, it is, I mean, I probably won't even do business with someone if they don't accept stablecoins or crypto, because it just makes my life too difficult. I'd rather go to somebody who does. So lesson out there, if you guys are watching and you're not accepting crypto for foreign payments and you're doing international business and something like if you can't use PayPal or Venmo very easily, please do yourself a favor and do your customers a favor and get on board with crypto, get on board with stablecoins, accept them, make everyone's life a million times easier. Because if you're on Ethereum, in 12 seconds, you got your money. If you're on Solana, in 1 second, you got your money. Either way, it's infinitely easier and cheaper than using traditional systems. Tether remains the anchor of this ecosystem, with a market cap of 148 billion and more than 113 billion parked in short-term treasuries. And these reserves are now generating seriously meaningful returns. According to its co-founder, future stablecoins may be backed by tokenized gold or money market funds, potentially unlocking new layers of yield and competing with traditional dollar-pegged products. Meanwhile, US policymakers are inching closer to formal legislation. The Genius Act, designed to provide a regulatory framework for stablecoin issuers, is gaining attention, and for good reason. And World Liberty Financial's USD1, tied to the Trump family, is already piloting zero-fee transactions on the BNB chain and teasing airdrops to accelerate growth. Crazy. Citi projects the stablecoin market could reach 3.7 trillion by 2030 with the right regulatory tailwinds and institutional support. Even under more conservative estimates, adoption remains on an upward path. The infrastructure is being built, the use cases are multiplying, and global demand for digital dollars continues to rise. And as this foundation strengthens, it opens the door to something even bigger. The past few months have revealed something major. Tectonic shifts in global capital are now underway. Institutional money is moving, not just in headlines, but real flows, balance sheets, and sovereign reserve policy. As these shifts accelerate, the dollar is starting to feel the pressure. Confidence in its long-term strength is weakening, and large asset holders are quietly adjusting. The growing adoption of Bitcoin by corporations and governments is not an isolated trend. It's part of a deeper rebalancing, a search for something solid in a system that no longer feels reliable. As trust in traditional structures erodes, Bitcoin is emerging as a financial hedge against inflation and fragile structures. Around the world, central banks are reducing their exposure to US treasuries and increasing their gold holdings. They're giving up yield and securing safety. Bitcoin represents the next step in that evolution. It offers all the qualities of gold, scarcity, neutrality, durability, while also adding portability, transparency, and independence from any nation state or central bank. Research from Bitwise shows that Bitcoin now has the strongest negative correlation to the US dollar among all major asset classes. When the dollar weakens, like it's happening right now, Bitcoin doesn't just hold up, it surges. This is a real-time repricing of trust, and Bitcoin is benefiting. Bitcoin's next all-time high isn't some distant hope. The path is already being laid out, and signals are too hard to ignore. Institutional money is shifting. Liquidity is accelerating. Corporations are allocating treasury capital into Bitcoin. State governments are introducing legislation to support it. And sovereign wealth funds are beginning to build national reserves. All of this is happening while confidence in the traditional system is quietly eroding. Bitcoin is no longer waiting on hype. It's gaining ground because the world is being forced to look for something better. And it's finding it in, you got it, Bitcoin. The countdown is already underway. By the time the world realizes what's actually happening, the opportunity may have already passed you by. If this helped you, ladies and gentlemen, see the big picture, make sure to like the video, drop your Bitcoin price targets in the comments. Let me hear them. What do you guys think? By the end of the year, where's Bitcoin gonna be? 100,000, 200,000, 500,000, a million? Let me know. And again, guys, if you're not subscribed to the channel, make sure that you do it. We put out the best macro videos in the world as it comes to Bitcoin. And until next time, ladies and gentlemen, stay sharp and stack sats.